Time now to take the discussion forward. Mr. Giri, the head of research at IIFL Securities, joining us on the show right now. Hi, Mr. Giri. Good to be speaking with you. Just wanted to begin by asking you as to what we should expect from the markets over the course of next 12 months. I mean, in 2023, we had seen a return of almost 19 to 20% from the Nifty. 9 months so far, Nifty has run up 19%, clearly much ahead of the averages that we have seen. Do you expect it to normalize over the next 12 months, or this bout of outperformance can continue?
Well, we are at almost 22 times 1 year forward. And from this level, one should not really expect a massive outperformance unless there is a case for large earnings upgrades. We have built about 12% earnings growth Y on Y, and maybe it can go up to 15% if commodities stay soft. We've had Israel and Lebanon now fighting, and we've had Russia, Ukraine go on, and we've had the Saudis cut, and the rest of the OPEC members also cut production. Nothing has saved crude from threatening the $70 level on the way down. So it could be quite good for Indian companies' earnings, which are typically very positively reactive to soft commodities. Also, monetary easing is starting and will happen globally. So that's one more reason to expect that the Indian cost base will behave more favorably. So maybe the earnings growth can be 15%. There might be a bit of derating, although I don't really think that the India story calls for any sort of derating. It will probably continue to command a premium. So I would expect the market to do about 12% from the current levels, 10 to 12%. Now, whether that is an outperformance or not, you can decide by looking at the other markets. I think it would be an outperformance.
It is indeed an outperformance given the context, but this 12% return that you're expecting, do you think it will be more skewed towards large cap outperforming now versus the small and mid cap, or do you expect much higher returns from this mid category versus large caps?
See, the MSCI index is at, and MSCI small cap index, standard and small cap indices are at very big discounts to the MSCI mid cap index. And it's the same story, about 22, 23x multiple for the large cap and small cap versus the mid cap multiple of 39x. So I think there is a problem with the specific list of stocks that are included in mid caps. Most of them are too expensive compared to their sector peers in large cap and small cap categories. So I think the mid cap index will underperform the other two. As far as the small cap is concerned, we have done an analysis some time back, which I can later share with you, which suggests that in any period, strong growth period or a weak growth period, the small cap EPS earnings on average are almost double that of the large cap EPS earnings. So that means that we have a good case to expect the small cap index to keep pace with the large cap index in the next 12 months.
Okay. Among sectors, if you look at NBFC is one of your preferred themes, but given the fact that there is a rate cut expectation that is there, don't you think on the short term it could have a financial impact on the NBFCs?
NBFCs typically behave very well when a rate cut cycle starts, and many things support that. Some indirect factors are also there. For example, uh, gold does well, and if gold does well, the value goes up, so that supports. Also, the NBFC borrowing cost base itself comes down, so their loans become more attractively priced. People buy more stuff, consumption accelerates, mortgages accelerate. So a number of things will play in favor of NBFCs relative to banks, especially, and relative to other sectors. And NBFC growth itself has generally been good. Even if you take the upper quality NBFCs like Bajaj Finance and Chola, and you don't really need to go down the risk curve. And look at the growth rates. It's like 25, 30% even after a slowdown in an economy where the nominal GDP growth rate is only 8.5%. So where is 8.5%? Where is 25%? So you have such a big growth advantage in NBFCs, plus this monetary easing and expectation of yields coming lower. That NBFCs, even though some of them might be a little bit expensive, will outperform.
Cement is also one of the preferred themes of IFL, but in the past for the past like 2 years, we have not seen any meaningful increase when it comes to prices. Yes, demand has been going up, but given the fact that pricing is continuously weak and there is the competitive intensity in the sector is too high, what are the reasons that you're bullish on the cement sector?
Number one, competitive intensity is high, but at the same time, consolidation is also happening, and the big players are going to get much more dominant than they've been. Number two, if you look at the biggest demand for cement, it comes from real estate. And if you look at the um, inventory levels in residential real estate, if you look at the Knight Frank data or one of the other main databases, you'll see that the inventory levels have come down in the last 4 or 5 years from around 3.5 years of inventory to about 1.5 years of inventory. And you can't really go down below 1.5 years because you take that much time to construct. And therefore, incrementally, if interest rates are going to be softer than they've been, and the real estate end product sales are still going to continue to have some sort of momentum, the new construction intensity will be much more. So, therefore, there will be a much more powerful pull from real estate demand as far as cement is concerned than we have seen in the last couple of years. And then the rest of the space, infrastructure, and other things that create cement demand are continuing at a rate higher than NGDP quite significantly. Look at the government capex, 17%. So that's two times the NGDP growth rate. So I think cement has been also beset with all of these other conversations about competition increasing and all that. That's partly in the price. And lastly, if you look at the recent period, elections and monsoons have depressed the recent demand. So all of it, I think, should come together in the next 3 months, and you should see a very above normal rally in cement.
Above normal rally in cement, but the above normal rally is underway when it comes to metals as a pack as well, and it looks like the China factor is really playing out. What's your view on metals, and what about PSUs? Because the likes of defense, etc., are getting under pressure of late. They have come off from highs.
Yeah, I'll talk about the metals first, then defense. As far as metals are concerned, they don't really react to rate cuts as much as they react to immediate supply and demand. And immediate supply is still preserved, but demand is soft. And in fact, with crude going down and the energy costs staying soft, actually the supply of metals will be reasonably robust as far as the energy factor is concerned. So therefore, I don't expect metals to immediately move up, but the metal stocks move up much quicker than the metal commodity prices themselves. And that, I think, is what is going to happen in the next 12 months. We'll see metals outperform. That should be one of the sectors, maybe not the top sector, but one of the sectors that will outperform. And also, we do see some reaction by the Chinese government and central bank to try to stimulate their economy. And we see what happened to crude and other commodities when the China GDP data came out. So I think there is a case to say that in the next 12 months, the efforts to stimulate the economy in China will continue. And at some point, there will be some movement in their economy and metals will rally also. And with that, metal stocks will lead the way. As far as defense is concerned, on the date of elections, we downgraded the entire cap goods sector by one or two notches for every stock, literally. And defense is also one of the sectors where we applied the hatchet. Now, defense is, I think, slightly overhyped because it's very difficult for any Indian company to become a global defense supplier or become a big defense exporter because the cycle for getting a product to get accepted is very, very long, like 4 to 5 years, whether it's an export market or the Indian market we are talking about. And Indian defense forces typically like the best technologies, and to develop that and come to parity with international suppliers is a multi-year cycle. So I think it's going to be more a case of smart Indian companies buying up properties in markets abroad, where the companies they buy are already suppliers into international defense demand, like NATO's demand or other Asian demand. An Indian company becoming very big in defense exports in the next 3 4 years looks unlikely to me. I think that sector and PSUs in general have some downside. PSU banks is a space where we've been much more negative compared to private banks, where we've been neutral to positive. And I think that call is played out nicely, and there is more to come in that.
Okay, so on the back foot when it comes to PSU banks, defense too has some downside risk, but metals, at least in the near term, might see a bit of an outperformance. Thanks so much, Mr. Giri, for making time and speaking with us. Appreciate you joining us on this show today.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.